Hey, what's up everyone? We've got another episode today of a portfolio review of a famous investor. And this time we're taking a look at Cathie Wood and her company Ark Invest. And by the way, if you want to see past episodes where we reviewed portfolios of other famous investors like Warren Buffett or Bill Gates, make sure you check out the playlist that I created, and I'll have it linked for you down in the description and at the end of this video on a clickable card. But I hope you guys enjoy this, and thank you to everyone who always hits the like button. It really helps the channel survive, and it means a lot to me. Now, I say Cathie Wood, but we're really going to be taking a look at her investing company called Ark Invest, which is famous for investing in disruptive companies that are looking to change the way things are traditionally done in the world, making them exciting companies for the future. And one such company would be Tesla, which Ark Invest famously holds extremely high price targets on. Now, Ark has several different ETFs made up of companies like this, but we're just going to take a look at the most popular one, and that's their Ark Innovation ETF, ticker symbol ARKK, and it states here that it is focused on Ark's belief that innovation is key to growth. The ETF is built on the cornerstone investments that present the best risk-reward opportunities from Ark's innovation-based themes. And the portfolio manager here is, of course, Cathie Wood. They had almost $2 billion in assets as of the end of last year, and it typically holds 35 to 55 stocks, but we'll just take a look at the top 10 largest, and I'll give my personal opinion on each in a very fast, rapid-fire style. And by the way, it looks like this ETF has done very well over the past 5 years, as it's nearly tripled during that time, and it actually has since the start of 2016. Now, in my previous portfolio review videos, I would give my really quick opinion on each stock and then rank them from best to worst using a tier list ranking system. And we're still going to be doing that, but I'm no longer going to call it a tier list because it was just kind of confusing people. So we're just going to call it just a typical ranking from best to worst, stock number 1 to number 10. But quick disclaimer, that does not mean that the bottom stocks are like trash or that they suck. And it does not mean that the top stocks are a great buy or anything like that. This is all just based on my opinion. And we'll be looking at these stocks based on today's prices and based on their growth and their valuation and maybe their dividends if they pay any, and maybe other things like brand strength and things like that. But as always, do your own research and make your own decisions. We're just kind of doing this for fun. Okay, let's go ahead and start here, and let's start with the smallest stocks, and then we'll work our way up to the largest stocks of the portfolio. Okay, now coming in at stock number 10, that's going to be Proto Labs, ticker symbol PRLB, at over 3% of the ETF. And like the name suggests, this is a company that builds prototypes and supplies low volume production parts to companies and designers and engineers, and it uses fast technologies to do this quickly, like 3D printing, for example, which helps them get their products out to their customers in just a matter of days. Now, the stock has been pretty volatile over the years, but is still up by over 35% over the past 5 years, despite crashing pretty heavily since 2018 by close to 40%. Much of that is due to the recent plateauing of their growth, as sales once soared by 15% in 2017 and 30% in 2018, but then crashed to just 3% growth last year, and only another 3% growth is expected this year as well, before recovering a little next year to 8%, but that's still a lot lower than previous years. Management has mostly blamed this on a weak macroeconomy that has likely been suppressed by the whole trade war, as companies have been less willing to submit new orders. And even though there's still a ton of growth to be had in their markets, especially in 3D printing, where they grew sales by double digits last quarter, their other segments are weighing them down. And the problem is that 3D printing is actually their lowest margin segment, believe it or not, and that's ultimately been weighing on profits, as they technically have been profitable for years now, but their EPS is expected to drop by a double-digit percentage this year. However, Wall Street seems to be optimistic about their future, as they expect a pretty large recovery next year of 23%, while averaging over 20% growth each year over the next 5 years. And that's ultimately leading to a little bit of a tricky valuation, as their trailing PE ratio is 100% higher than the sector, but that drops to 68% higher forward, and then 18% on a 5-year PEG ratio basis, meaning that they're pretty much expected to slowly grow into that valuation over time. And hey, with the future of 3D printing, that might actually be the case, but as of right now, this is still a stock with a premium valuation and mediocre growth. The 3D printing aspect has me curious though, so I may research them more in the future, but for now, I'll put them at around the number 5 spot in the middle, and I'll just kind of adjust them later as we go through the list. By the way, they do not currently pay any dividends. Okay, coming in here as the 9th largest stock in the ETF, that's going to be Roku, ticker symbol ROKU, at over 3.3%. And unlike the last stock, this one is a much more popular brand, just kind of in the general sense. So I'm sure you guys have heard of this one. You've probably heard of the Roku devices that let you basically turn any TV into a smart TV to use things like Netflix and Amazon Prime Video. But with the growing popularity of smart TVs, I actually don't see a lot of people buying Roku devices anymore. Still, that may not be as big of a problem as you might think, since they themselves actually partner with TV brands to make Roku smart TVs that run on Roku's operating system. On top of that, Roku has their own streaming service as well, and one of the ways that they monetize it is by having a free ad-supported version, which is still a tiny market that has a lot of growth potential. For example, Ampere Analysis estimates that only 3 to 6% of US households currently use ad-supported video services, and Roku TV is the most popular among them. Meanwhile, these type of services are carving out a little kind of niche area of the market with older content, as services like Netflix are shifting their focus to new and original content, as their percentage of content that is over 5 years old has shrunk from 50% in 2015 to as little as 35% last year, while services like Roku rely on it for around 80% of their catalog. And so far, these different strategies have been working very well for Roku, as sales have been absolutely soaring over the years, and the result of that very high revenue growth has been a soaring stock price as well, that even though it's come down a bit from their highs last year, is still up by almost 400% since they IPO'd in 2017, which is very impressive. Unfortunately though, it doesn't look like they are profitable at this time, as they consistently lose millions of dollars a year, at least when looking at net income, and that makes it difficult to value the stock, as their price to sales ratio is close to 800% higher than the sector. And for context, it's also more than double that of something like Tesla, which, by the way, Tesla has just as much growth as Roku, and they're actually expected to be profitable going forward. I get that Roku is being seen as a disruptive force in the market, but I think the video streaming market is becoming more competitive every year, and I just don't think that they have anything special that other companies can't replicate. So for those reasons, I'm going to put them right behind Proto Labs for now, even though they do admittedly have a lot of revenue growth on their side. Okay, next up here we have Intellia Therapeutics, ticker symbol NTLA, as the 8th largest stock at over 3.5% of the ETF. And this is a biotech company that is mostly known for their own versions of CRISPR genome editing technology that edits or modifies a patient's DNA to fix genetic diseases or mutations and chronic illnesses. Now, this is still kind of new technology, and as such, Intellia's stock has been very volatile over the years and has lost more than half its value since they IPO'd back in 2016. And that's one of the reasons why I don't usually invest in biotechs myself, because they're usually riddled with speculation and volatility, and I just don't have the time to do all the research necessary to stay on top of these type of companies and the progress and or mistakes that they are making. In Intellia's case though, the bad stock performance might be due to the fact that competitors like CRISPR Therapeutics and Editas Medicine have already started trial versions of their own leading programs, while Intellia is lagging behind a little, as they are set to launch their trial programs later this year, at least according to the Motley Fool. As you would expect, those sales are basically all over the place, with growth dropping from 63% in 2017 to just 15% in 2018, then surging to 40% growth expected for fiscal 2019, only to drop down again to just 2% in 2020. So what that tells me is that it's very hard to predict where their business is going, and it's all just kind of highly dependent on whether their programs become a major success or they flop. Meanwhile, they are not currently profitable, having lost close to $100 million over the past year alone, which is around 3 times what they, 3 times more than what they generated in sales. And their price to sales ratio is also sky high at almost 17. Obviously, these things won't matter to you if you believe in what they're doing and you think that they'll be successful in the future, but I'm just not knowledgeable enough about this company or the market to rank them higher on the list. And for that reason, coupled with the lack of profitability and difficult to predict revenue growth, I'll have to place them at the bottom of the list for now, even though they may actually have the most upside potential. Okay, moving on here to stock number 7. That's going to be a stock that I actually used to own myself, and that's 2U, ticker symbol TWOU, at almost 3.7% of the ETF. And if you guys have seen my previous videos, then you know that this is an online education company that once had a ton of promise because of how the education market is really shifting more heavily towards online. And 2U is a really big play on that, given that they're partnered with over 70 universities, including big names like Harvard and USC. And so all of that future potential led to the stock skyrocketing through 2018 before falling off a cliff due to an increase in competition that led to lower guidance, which, by the way, management did a horrible job of communicating to investors. And that was actually the reason why I decided to leave the stock myself. But as it stands, revenue growth is expected to drop from 40% growth last year down to 28% this year, and then 16% next year. Luckily, my position was very tiny at around 1 or 2% of my portfolio, but I still hold a more negative view of the company as I had to sell for a 15% loss because I just really lost faith in management. In any case, they continue to be unprofitable, having lost over $200 million in the past year alone, and while they do still have some pretty decent revenue growth coupled with a pretty reasonable PS ratio of less than 3, I just can't bring myself to put them higher than any of these other companies because I've just had such a bad experience with them myself. If they're able to turn things around though, I think they could have a very bright future in the high growth online education market, but as of right now, I just have a little bit of a bad taste in my mouth. Okay, I gotta say guys, so far this ETF has been filled with a lot of speculation and volatility, which is understandable because they're focused on disruption, which means that they have to bet heavy on underdogs, but let's see if it gets a little more stable here as we go higher up on the list. Well, it looks like we're going to have to keep waiting since stock number 6 is going to be a competitor and very similar stock to NTLA, and that's CRISPR Therapeutics, ticker symbol CRSP, at about 4.4% of the ETF. And as you might imagine by the name, this is another major play on the future of CRISPR-Cas9 technologies to manipulate genes and cure illnesses potentially. And some investors actually like CRISPR Therapeutics the most because they've been faster to advance their programs into clinical trials over their competition, and that's led to the stock more than tripling over the past few years and outperforming their peers in terms of stock price appreciation. Like their peers though, business performance has been all over the place, and while they did have a gigantic surge in sales last year thanks to a partnership with Vertex Pharmaceuticals that also helped them achieve positive net income as well, they typically lose money, and sales are expected to drop heavily this year again as the partnership with Vertex consisted of a very large upfront payments that won't be received again. However, the interesting thing is that in the press release, they actually mentioned that there's the potential for royalty payments down the line since Vertex is going to be using CRISPR's technologies. In any case, this remains another highly speculative stock, but because practically every stock on the list is speculative, I'm actually going to put them at the top of the list for now because it's the most interesting spec play, at least for me personally, of the bunch, because if they ever happen to come out with more affordable treatments for things like cancer, then this one probably has the most reward potential of the list. And the way I see it, they're all pretty risky anyway. Okay, we're now cracking into the top 5 stocks, and coming in at number 5, that's going to be Stratasys, ticker symbol SSYS, at over 5% of the ETF. And this is another horribly beaten down stock as they have crashed by over 70% over the past 5 years, and that's probably because this is another 3D printing related company that sells printers and related softwares and services. And the problem with 3D companies is that the market has taken a lot longer to materialize than everyone was expecting, and that led to some big crashes for these stocks as they came back down to reality. But unlike Proto Labs, Stratasys has been consistently losing money for years on the bottom line, and while Proto Labs has been growing their sales, Stratasys has been mostly shrinking in that department as well. Still, it appears that analysts are expecting a rebound possibly in the European and Chinese markets that have been dragging their business down, as they expect extremely high EPS growth over the next 5 years, and that ultimately gives them a much more reasonable valuation with a PEG ratio of less than 1. Still, until they can actually prove their turnaround, I think this remains a highly speculative stock, and if you're going to be speculating, I think there's better options out there. So I'll put them just under ROKU for now, since ROKU also has negative net income but much higher and actually positive revenue growth. I'll still put them above NTLA though, because of the better valuation. All right, moving on to stock number 4, that's going to be Illumina, ticker symbol ILMN, at over 6% of the ETF. And this is another biotech that is actually the market leader in DNA sequencing, where they scan or map and analyze DNA variation and functions to solve problems related to things like cancer cell mutations and genetic diseases. So there's probably a lot of similarities to the other DNA related stocks that we mentioned earlier, but I guess maybe the differentiating factor might be that this one seems a little more kind of analytical and seems like they do more testing work. In any case, they've so far been doing a pretty good job bringing in billions of dollars in sales with decent growth rates to go along with it, and some very welcome profitability that we're not really used to seeing on this list. And the stock has mostly reflected this success over the years, although they did pull back a bit from their highs, partly due to the failure of acquiring Pacific Biosciences because of regulatory pressures from agencies that were worried about Illumina becoming a monopoly in the market. Still, there's reasons to be optimistic for the future thanks to a new partnership with Roche, as well as the launch of new sequencing products. Unfortunately, though, Wall Street knows this, and thus the stock is trading for a 16% premium to the sector. But given the stronger overall performance coupled with future potential, I'm going to put this stock at the top of the list for now, and I may even research them further myself in the future, even though I rarely touch biotechs because I'm just not very knowledgeable about the market. Okay, now we're breaking into the top 3 now, and coming in here as the first one, that's going to be Invitae, ticker symbol NVTA, at 7% of the ETF. And this is yet another player in the genetics market, but from my understanding, they seem to be much more heavily involved in just testing, as they provide a wide array of individual screenings for various diseases, and then help those customers interpret the data and work on finding the right treatments or solutions. And hey, so far their approach to the market has been working, as sales have been absolutely soaring over the years by very high rates. Unfortunately though, this is yet another company that is not profitable, with losses that have been growing larger every year. Still, the surging sales and promising future seems to be enough to win over investors, as the stock is currently trading near record highs after having climbed by over 50% in the past 5 years. Without profitability though, their valuation is much more dependent on sales, and currently their price to sales ratio is very high at over 13. And with those losses getting larger every year, it's difficult for me to think of them as anything other than a future spec play, and for that reason I'll have to put them just barely behind CRISPR, as all of these are spec plays anyway, and I think CRISPR could have the larger breakout, but I'll keep them ahead of all the others because of that really high revenue growth and the future potential. Okay, coming in here at stock number 2 on the list, that's going to be Square, ticker symbol SQ, at about 7.5% of the ETF. And this is a much more well-known company than most of the others, as you've probably seen someone using that little attachment on a phone to accept payments when they're selling something. But that, along with other financial services, has made Square a very popular platform to use among merchants and retailers that need a simple way of charging their customers digitally, not to mention that Square is even pushing to be one of the largest cryptocurrency accepting networks in the world, which could lead to a lot of future growth depending on how everything plays out over the long term. Meanwhile, all of this innovation has led to surging sales for them that look to be slowing down a little right now, but are still extremely high at close to 30% expected growth in fiscal 2020. Still, this is yet another company that consistently loses millions of dollars every year, and while I completely understand that losses are usually necessary at the early stages of the business, and especially if you want to expand and scale up into a more dominant company in the future, but as it stands, that lack of profitability means that any good or bad news will likely send a stock like this either surging or crashing, and it's also led to a very volatile stock over the years. Still, they're technically up by close to 600% since they IPO'd, and that's led to a much higher valuation. When looking at sales, their PS ratio is over 8. However, it appears that analysts are expecting Square to become profitable soon, with a forward PE ratio of over 86 and a PEG ratio of less than 3. As is the case though with most newly profitable companies, those profits tend to skyrocket in the first few years, and analysts think that their EPS growth will be as high as almost 40% on average over the next 5 years. Still, even with that high growth, the valuation is very high, and any mistakes could lead to the stock taking a nasty hit. So I'm going to put Square behind CRISPR for now, as I'm not a very big fan of Square myself, and I think CRISPR could have larger success on a technological breakout, but I'll keep them higher than the others since Wall Street seems to be very optimistic about their future. And finally, at stock number 1, we have the almighty Tesla, ticker symbol TSLA, at over 10% of the ETF. And this is the only stock on the list that I actually own myself. And I'm sure you guys know about Tesla already. They're a huge play on the future of electrification and autonomous driving with their Tesla vehicles, as well as renewable energy with their battery and storage products and technologies, and even ride-hailing with a planned launch of a robo-taxi service in the future, not to mention freight with the upcoming semi-truck. And look, there's no way to sugarcoat this. Tesla stock has been on an absolute tear lately, climbing to record highs as they are currently up by close to 300% over the past 5 years, and almost all of those gains have come within the past year or so. And that's led to a very high valuation no matter what metric you look at. Still, it's my opinion that Tesla can grow into this valuation over the long term when you consider their enormous growth that I also predict will surprise to the upside even with these higher expectations. Now, they haven't had a full year of positive net income yet, but they've made a ton of progress in generating positive free cash flow in 5 of the last 6 quarters, while net income is expected to be positive in future years, with EPS growth of 35% on average over the next 5 years, while major competitors like Ford and GM are actually expected to be negative. Meanwhile, sales have been on an absolute tear, with expected growth of around 30% or more in each of the next 2 years, while those same competitors are either much lower or even negative. I won't spend a ton of time talking about Tesla here because I've already made like a bunch of videos on them, but you guys know how bullish I am on them, and with all the speculation in this ETF, Tesla is the only company that I really believe in as an actual long-term solid investment. So I have to put them at number 1 above all the others. Again, other than Tesla, I really feel like most of these stocks are just very high risk, kind of speculative stocks. And look, they do have a lot of high reward potential, and I don't necessarily have anything wrong with spec stocks. I think it's okay to have, a tiny amount of your portfolio in a spec stock or two, and sometimes you can actually hit it really big and it can give you some nice returns. But in terms of like solid kind of foundational stocks to build portfolios around, I'm just not really seeing that with any of these stocks, except for maybe Tesla. But anyway, that's just my opinions. I would love to hear what you guys think down below, and I will definitely continue to watch these because some of them are actually very interesting, especially those biotechs. I think a lot of those are very interesting. But anyway, leave your thoughts down below and let me know if you agree with my overall ranking or if you would make any changes. And thanks for watching the video. I hope you guys enjoyed it. If you did, make sure you hit the like button, and I'll catch you guys in the next one. Thanks again. Take care. Bye-bye.